Gentlemen, welcome back. You're back with MGTOW Money. Today's topic will be the ABCs of the stock market. And for those of you new here, this, of course, is MGTOW Money, the only MGTOW channel dedicated to your financial freedom, how to make money, how to invest it better, and potentially how to even retire early. Today's topic was a request that came in, and I appreciate those requests, and will be the first of 3 videos that I'll be doing on stock market investing. And then we will talk about the bond market, and separate from that, we will talk about ETFs and mutual funds in the third video. Now, let me warn you, let me just be absolutely clear. This is the very basics of stock market investing. There'll be no discussion of hedge fund quantitative analysis, stock valuation metrics, technical analysis, candlestick charts, Graham's book on value investing. All those subjects require hours and hours and hours. This is the absolute very basics. This is information that I'd be providing to my grandmother or someone who has no stock market experience, no stock market knowledge, because we have to start somewhere. So if you already have experience, there's probably something else that you can do that's more profitable with your time than listening to this. Moving on, let's define what we mean by a stock. Let's define a stock. Let's define what it means to be a shareholder, to own a share of a stock. What we're talking about is you as a shareholder, you as a stockholder, own a portion of a business, a percentage of a business. You own, although it might only be a very small, tiny portion of a business. It might be similar to a grain of sand in the Sahara. You can be the owner of Facebook, Tesla Motors, ExxonMobil, Hilton Hotels. That is what it means to own a share of stock. You can be a shareholder. You can own 1 share, 2 shares, 1,000,000 shares, 10,000 shares, whatever number you want to happen to come up with. When we talk about a stock exchange is an actual physical place. There's one in New York, for example. There's one in London. There's one in Paris. I believe there's one in Sydney, Australia. There's many, many stock markets, stock exchanges around the world where people meet, physical people meet together, just like you'd meet at a fish market, just like you meet at a vegetable market, a produce market, to buy and sell shares of stock. They're doing the same thing, albeit today, much of this is done electronically. When you're engaging a stockbroker, all that you're doing is that person is acting as an intermediary for you at that stock exchange to buy or sell stocks on your behalf. So you're just asking them, hey, Mr. Stockbroker, go to the stock exchange and buy me X amount of shares of this, or sell my shares that I already own, for example, or short in this particular stock. They will do it for you. You pay them a small commission. So therefore, you don't have to go there. You don't have to go to New York. You don't have to go to your local stock exchange to do it. They're doing it for you. They have those connections. They have that membership to do so. Most importantly, what you guys really want to know is, how do I make money owning stocks? There's going to be 2 basic ways that you're going to make money in stock ownership. That's going to be either through a capital gain, and I'm also going to talk about potential losses here in a moment, or through dividends. Let's focus on gains that all of you are probably most familiar with. If a stock rises in price, you buy a $10 stock, it goes to $12, you've made a $2 gain. Happens all the time, every day of the week, and people get very, very lucky doing so, or they end up losing money as it goes the other direction. We'll get to capital losses in just a minute. A real-life example from my own experience. Some years ago, I purchased Yahoo stock in the low 20s, and it rose to the mid-30s. The reason why I bought it, there was some speculation about at that particular time, they had a significant chunk of Alibaba, and this is before the spin out. The point being, the stock rose in about a 6 or 8 month period from the low 20s to the mid 30s. So I made around $13 a share, just using round numbers. If I had 100 shares, I made $1,300. Did that make me rich? No. But hey, it was easy money, relatively speaking. It came in a relatively short period of time, and fortunately, I had more than 100 shares. Now, it could have just as easily, though, gone the other direction and gone down on me, and I could have been sitting on a capital loss if I would have sold. How does a stock rise or fall? Stocks rise and fall for infinite number of reasons, but it's just like in an auction. People get excited about a particular item, or they hear news clippings. Let's say this company, hey, there's a rumor this company is going to have a cure for cancer, and they're going to make billions, potentially trillions of dollars from this cure of cancer. So everyone wants to own a portion of this business because it's going to be amazingly profitable to their shareholders, to the owners of the company. However, let's say another company, on the other hand, in this case, they're having financial issues. There's potential fraud going on. Maybe they've been running some sort of weird Ponzi scheme. The stock can go the other direction. So it becomes a reverse auction. The supply of shares in terms of the people that want to sell overwhelms the buyers. And so the stock goes down. It becomes a supply and demand situation. Look at the charts that I've posted of stocks that have amazingly gone up dramatically and just as amazingly gone down dramatically. Look at, for example, the stock of Enron, that chart that I show here, how this was one of those stocks where, hey, this is the best thing since sliced bread. They've got this amazing piece of technology. This time is different, and the stock went to zero. That's correct, gentlemen. The stock went from 90 to zero. Look at the chart if you don't believe me. That was one of many, many other stocks that have done so. It can happen. You can have a capital gain. You can have a capital loss. Another great example that I like to think about in terms of how investing can be extremely profitable, and this especially applies for those of you who have lots of patience and can literally just turn off the news channels and ignore all the financial advice you might hear. Think about Berkshire Hathaway. This, of course, was founded by Warren Buffett, one of the richest men, not just in the United States, in the world. Multi-billionaire. If I'm not mistaken, he's worth 50 billion plus. That's USD. This is a man, his stock was trading for, I think it was around $21 in around 1968. So approximately 50 years ago. Today, that same stock, Berkshire A shares, the Class A shares, by the way, the symbol, all stocks have a symbol, BRK.A, is selling today, right now on the stock exchange. You can buy one share, gentlemen, $249,000 USD. Yes, gentlemen, for one share of stock, approximately $250,000 US dollars for one single share of stock that you could have bought 50 years ago for approximately $21. So it can happen. You can also look at charts of Dell Computer, Amazon, Apple. These are all stocks. If you had bought and held them, you could have done extraordinarily well. For those of you who are not so lucky to have bought those stocks when they were very, very low, let's talk about another way that you can make money. Dividends. Dividends are a fantastic passive investment. In other words, once you buy a stock that's paying a dividend, you can literally go to sleep and know you're going to be paid. Dividends are typically paid by the company out of profits that they've earned, and typically they're paid on a quarterly basis. They will automatically show up in your bank account. Again, they're passive. You don't have to do anything. You bought the stock, you're an owner in the stock, and it pays you a dividend. Dividends are typically paid by large, established corporations. Corporations that have been around for many, many years that are reasonably profitable. Lockheed Martin, for example, they're a large defense contractor. They pay a dividend. Your local bank, if it's a large bank and they have many branches, they're probably publicly traded. They probably pay a dividend. Your local electric company, water company, utilities, again, typically companies like this that have consistent cash flow pay dividends. The dividend is expressed in a percentage of the stock price. A real easy example, a $10 stock with a 5% dividend pays a 50-cent annualized dividend. You're saying, well, that's only 50 cents. You're right. But presumably you own more than just one single share of that $10 stock. You can see if I own 1,000 shares of that single stock, it can start adding up. And it can be a terrific way for someone not only to diversify their portfolio, but someone who just wants to get a little extra money to do so. Let me mention another stock. I've mentioned this before. I don't own it, but another stock that I think is very interesting is Realty Corp, Real Estate Investment Corporation. This company's been paying a dividend for well over 20 years, and they pay it on a monthly basis. So if you're a person who's considering early retirement or has a goal for early retirement, this is a great little way to supplement your income with a monthly dividend check from them. And by the way, their stock symbol is O. Again, I don't own the stock. I'm not necessarily recommending it. Do your own research. It's just very, very unique and interesting to me. Let me sum up, gentlemen, by saying, again, 2 ways to make money in the stock market. 1, capital gains. You buy the stock at $10, goes to $12. You've made a profit. Point number 2, you can earn dividends in the stock. Again, it's paying you a percentage of the stock price based upon whatever you purchased it at. With all that said, with all these fantastic things, man, hey, ching, ching, ching. I know, I get it. The slot machine's going off in your mind in terms of how much money you can make. Let me provide a couple of warnings, though, about investing, in particular in individual stocks. Number 1, as I mentioned, just like you can have capital gains, you can have capital losses. Stocks do obviously rise in price. They go down in price, and some stocks actually go to zero, bankrupt. You could be wiped out. Number 2, dividends are not guaranteed. Unlike when you put money into the bank, which guarantees you a rate of interest that'll be paid to you, dividends are not guaranteed. They can be cut. They can be even eliminated. In 2007, 2008, 2009, when the financial implosion happened, many companies reduced, if not outright eliminated, their dividends. Just be aware of that. Dividends are not guaranteed. If you choose to buy individual stocks, which again, I accept, can be very, very profitable, also know, bear in mind, flipping that coin over, you can lose everything, or at least nearly everything. The stock can go down and stay down for years. Just be aware of that. So, never, ever, ever risk more than you're prepared to lose. In other words, if you're prepared to lose $1,000 maximum, put $1,000 into an individual stock. Do not put $1,001. Keep it at a maximum $1,000. Number 2, a suggestion for you. And this actually should apply to at least 80% of you, and certainly should apply to 80% of the money that you would put into the equity markets, a la the stock markets. Ideally, you probably should be sticking with mutual funds and exchange-traded funds. I'll have more to say about those on a future video, but I just want you to be aware of the very basics of stock market investing, as well as just owning individual securities. Let me finish by saying, gentlemen, we, of course, are building an international MGTOW army of financially independent men. And because we're going to move this forward, I need your help. I need you to share this channel with friends. I need you to post it on forums. I need you to hit the like button if you enjoyed this material, if you found it profitable. And just as importantly, if you haven't already subscribed, please hit the subscribe button now. As always, John Galt out.